The rupee's value versus the dollar is near its lowest point ever, even while stock valuations are still high. In 2024, the markets have been marked by a paradox, as the rupee has weakened despite gains in the equity markets and rising foreign exchange reserves. The first question that comes into mind is the rupee weakening or the dollar gaining. A good way to determine the strength of a currency is to compare it with a basket of currencies. In the case of the dollar, the movement of the dollar index shows the performance of the greenback against 6 primary currencies. Since April 2014, the dollar index has moved from 79.49 to 106.22, which is an appreciation of 33%. During the same period, the rupee moved from 59.9 against the US dollar to 83.54, which is a depreciation of 39.4%. However, since January 2024, the dollar index has moved from 103.05 to 106.22, a gain of 3%, while the rupee has weakened from 83.24 to 83.54, which is less than a percentage point. The rupee has weakened over 10 years, but the recent volatility reflects the dollar's strength. What is causing pressure on the rupee? Global market volatility brought about by geopolitical concerns in West Asia has resulted in crude oil prices lingering above $90 for Brent crude, the highest level in 5 months. India, which is one of the largest users of crude oil and heavily dependent on imports, is particularly negatively impacted by rising oil prices. If the rupee is weakening, why are forex reserves rising? Why isn't RBI using the reserves to support the rupee? India's forex reserves of $648 billion are the 3rd highest globally, after China and Japan. The critical difference between the reserves held by other export-led economies and India is that while countries like China and Japan build reserves due to the net earnings from trade, India's reserves comprise primarily of liabilities. The RBI has to sell dollars when these foreign investors choose to sell their investments and repatriate the money back home. A weak rupee makes imports costly and adds to inflation, but a country with a current account deficit cannot afford significant strengthening as it will increase imports, hurt exports, and worsen the current account balance. The rupee has consistently weakened, reflecting the difference in inflation between India and the US. When India experiences higher inflation rates compared to the United States or other major economies, the purchasing power of the Indian currency diminishes more rapidly than that of the US dollar. If the exchange rate fails to reflect this decrease in purchasing power and is artificially maintained at a high level, it prompts capital outflows from India as consumers seek to purchase goods and services from markets with lower inflation rates. To counteract this trend, central banks often permit the local currency to weaken. A weaker currency results in increased costs for foreign purchases and attracts more foreign capital. For example, when the US dollar strengthened against the euro, many US citizens opted to vacation in Europe because the exchange rate made it a more affordable destination for tourism. But why is the dollar gaining? The dollar's strength is due to the resilient US economy, leading investors to reassess their expectations for the Federal Reserve's interest rate cuts. Positive economic indicators, such as a tight labor market, upbeat consumer sentiment, and government subsidies for manufacturing, have contributed to the dollar's gains against virtually every major peer in 2024. What is the outlook for the dollar and the rupee? Expectations of higher for longer interest rates in the US could support the dollar. Investors are increasingly betting on dollar strength, indicating a prevailing sentiment that the strong greenback is likely to persist. However, increased foreign investment in India, particularly with the inclusion of Indian government bonds in global bond indices, is set to enhance India's balance of payments. The rupee's positive outlook is underscored by its favorable performance against various currencies, including the euro, amidst a stable external environment. Strengthening forex reserves and expectations of a low current account deficit for FY24 further bolster confidence.